Ladies and gentlemen of the crypto space, we're live on a Friday, October 27th at 11:32 a.m. All right, end of a week. Had two streams this week, and not much has changed since the beginning of the week. So, what does that mean? So, obviously, during the week, Japan had a pretty significant directionality with its currency, and it pushed through the 150 barrier. So what is fascinating is with regards to directionality is that there's some strangeness going on. So if Japan needs to defend its currency, and that how else does it spontaneously reverse from 150.4 down to 149.5 and all of a sudden it has downward pressure? Who's buying? And the thought that has been circulating through everyone's mind is they have their bank account, and their bank account is denominated in U.S. government debt. So they sell their U.S. government debt to defend their currency. But what's going on with U.S. government debt? It's not significantly up, 0.31% yield, because if they're selling the government debt, it depreciates the price and bumps yields up, albeit the long end is up by a little bit. So it's not clearly indicative that they are selling debt to defend their currency, where we don't see a 1%, 2%, 3% run on yields back to 5% on the 10-year. So we are still in limbo with understanding what directionality is, and that's kind of the point of the stream. Everyone's waiting. Everyone's waiting to figure out what the hell is gonna go. What the hell is going on? What the hell is playing out? Now, obviously, this plays into DXY, push back down, 1063 was up at 1067, 1068. Obviously, crypto did what it did this week. I don't think that narrative is exactly the case where it's just counterparty risk, and that's just not the way global financials work. Counterparty risk is also a matter of what you can even accept as a counterparty. For individual actors, family offices, maybe even hedge funds to a degree, but not big banks, and not even the largest of financial managers can just like consider an alternative to U.S. Treasuries. That's just not the structure of the system. You buy Treasuries for the same reason you buy dollars, because everyone accepts it. It is tradable, it is portable, it is accepted for settlement. Dollars, obviously, and likely U.S. government debt as well. So, what does that mean? That means that rip to 35. I mean, it literally is like a tick to 35 on Bitcoin. We've been hovering around like 33.8, 34.2. It's been a nice trading range. I guess maybe it legged up a little bit. Same with Ethereum to a degree, albeit Ethereum denominated in Bitcoin is marginally down. Chart is still structured well. I mean, come on, higher low? It's on a 6-month chart. And the 3-month chart, which is something I like to look at, I tell you guys when you're below a relatively long-term time weighted average price, 3 months, especially the 6-month, that's a decent opportunity from a entry standpoint. So 6-month is not much time to go on. But we're below on the 6-month as well. So when that corrects, when there's a mean regression, it's quite appealing when you see that kind of appreciation. Mean regression to the upside is quite nice to see. Now, Bitcoin never pushed below that 6-month TWAP. Isn't that quite fascinating? So we're marginally above, which means there's plenty of room for depreciation. There's plenty of room for a return to the mean. There's plenty of room for a systemic event as historically expressed in equity markets, most recently being a massive wick to the 6-month on the S&P 500. Different market structure back then, pre-2008. You could literally say that this was like a completely different world back then, with regard to how the markets operate. And now the highly talked about behavior is tied to liquidity. And I think that's quickly becoming consensus. And what I like to see is liquidity has been disrupted. Mike Howell talks about it, and other folks indicate there's plenty of reason for actors in the system, even government actors, to want a significant deleveraging. And then the counter to that is like stuff what Luke would say and others would say as well, that you can't deleverage because if you do, literally it falls apart. Trade will break down. The enterprise that execute international trade goes insolvent and they just don't operate. So if the gears of the machine seize, the whole system starts to fail. If all of a sudden, if there's no shipping out of material and consumer staples and commodities for purchase orders for, let's just say, literally Walmart and Target, the whole system starts to convulse because now their enterprise is completely disrupted, and then individuals who are completely dependent on those companies to provide their consumables are completely disrupted, and literally it just all gets completely disrupted. It's quite incredible how dependent and maybe just we don't really recognize it as much as we probably should, how dependent we are on just in time. You want a steak for dinner. You could go to the supermarket and buy it. It's not like you have to go to the supermarket and put in an order for a steak, and the supermarket puts in the order to the butcher, and the butcher puts in the order to the farm, and a week or two later, you have your purchasable steak ready. Yet alone if you actually had to grow the animal. So we are very dependent on everything literally working perfectly at all times. And that could be disrupted. So I've said in the tweet for this stream that the whole system is just set up to be extremely polar right now, especially the observations of where we may head, which makes the contrarian take that the markets literally do nothing. Isn't that what Stan Druckenmiller said? We might see nothing for a decade of nothing. That is a contrarian take, and I like those contrarian takes. So we see just a crab market for a long time as the system drains of liquidity. Things do fail, but they fail in an orderly way. And powers that be paper over enterprise of systemic importance. Winners are chosen. Liquidity remains relatively flat because if liquidity significantly decreases, then you start to get cascade effects. Relatively flat, meaning if liquidity slowly contracts over a period of time, then everyone has time to adjust. The things that blows up pension funds and like what happened in the UK is not necessarily the rate, it's the rate of change of the rates on the gilts and other debt instruments, the rate of change, the volatility, because that there isn't time to react and adjust and recompose the portfolio. But when there's time and volatility is low, so that could be a good way to describe what may play out with regard to crypto. So a crypto, if we don't have an increasing liquidity environment, this move was reallocation. This move was flows. Flows are based on narrative, but whether it's the counterparty narrative or not, maybe, I don't think the halving narrative was ever really a narrative. But maybe it is to a degree that it triggered flows, enough flows to trigger this kind of price action. Now, that would be interesting. And it's consistent very much what I have talked about, where if you have relatively flat liquidity in the system and it edges down slowly over time, they have this slow quantitative tightening at the US Fed, and other countries are probably stimulating to try and keep everything from falling apart and keep it held together, that we have this relatively slow bleed on global liquidity. The real economy suffers, bankruptcies remain high, and the whole system from an enterprise standpoint restructures into something new, a higher interest rate environment, which literally invalidates the business narrative for countless companies worldwide. Not it's countless, and literally, but probably percentage points of entire nations' enterprise. Um, and what happens in that regard? That's my bull case for crypto markets because I see these as enterprise, and that would indicate significant flows are potentially there. Flows from enterprise that have been invalidated to new enterprise that has more and more and more of an observable use case that are potentially integral to whatever financial structure emerges heading into the 2030s and maybe even the early 2030s. So clearly 2020 and 2021 were a liquidity driven frenzy in crypto markets. It may be the case that the next cycle is a flows driven environment. And that would make sense to me. They sure as hell don't want to juice systemic liquidity. What they want to do is control it and reduce it and bleed it over time, allowing organizations to adjust to the balance sheet composition requirements to remain solvent. They want to get the move. Where's move? Move is somewhere. Move is here. Move is through the roof, still at 130. So what they probably want to do is continue QT, keep rates high, try and keep Japan under control. I don't think they're going to intervene too much in corporate America, indirectly at best, via whatever liquidity program, but not like specific interventions, '08 style. And they'll paper over the biggest of banks, and the big banks will continue to consume the small banks, but the BTFP really papers over a good part of the regional banks, depending on whatever the deal is for the time frame of the BTFP loans. And all that entails exactly what we've been talking about. The real economy continues to suffer. Inflation probably comes down depending on supply chains. So that's why you can't have this high volatility, because there goes the international shipping companies, and there goes supply chains, and there goes inflation. So you could literally, like, folks have been talking about M2 coming down, the largest amount since before the Great Depression, probably the inception of the Fed at this point. And you could have the amount of currency in the world shrinking significantly. And then supply chains get disrupted and consumer price inflation blows through the roof. I point that out because obviously so many folks talk about Bitcoin fixes money because they could print when they want to. And I agree that I don't find it comforting that they could print when they want to. But it's more than just them printing. An economy has different pressures, and clearly they made massive mistakes. But the supply chain disruptions are very much the denominator. You change the dollar is the denominator with regard to currency, but as the price, the availability, the supply of actual consumables changes. That just ripples right into consumer price inflation, maybe even more so than the amount of currency in circulation. The amount of currency in circulation is in response to availability of natural resources. And then that's just governments, crowding out anyone else that doesn't have a printer. So they want to get consumer price inflation under control. I don't think it makes much of a difference what they do at the currency level. They need to make sure that the supply chains strengthen. The supply chains remain intact, not even just strengthen, just remain functioning, and then bleed the liquidity from the system and hope everyone forgets about all this shit they've done over the last couple of decades. So the halving might draw, because once momentum kicks in, cycles will cycle. I always say that. So we could easily see very large volatility in price in the crypto markets without the whole liquidity narrative, and certainly without equity markets, and just certainly without anyone that has a thought of why it should occur. Meaning, once the momentum starts, momentum has a way of building, and the cycle plays out, and we have great cyclicality in crypto markets. And this was a nice rip from 27 to 34. The halving narrative throws it over the edge. The ETFs throw it over the edge. And once it starts price appreciating, then capital gets sucked in for fear of not participating. Asset managers, portfolio managers, and all that shit. They're like, the clients call it, like, why the hell don't we own any of this? And then they're forced to take different behaviors with regard to how they compose their clients' portfolios. So that would be consistent with flows. It's not that the individuals, the people, the clients have just more excess money. It's just now they're forcing the existing capital to flow in different places, and in this instance, flow to the crypto markets. And I think that is quite a compelling thought, especially hopefully as more people and asset managers consider how to look at certain assets in crypto markets as enterprise, as a value evaluation, which is not a growth narrative. It's not what drives the price of Bitcoin. There's a whole philosophical and quantitative conversation that could be had about what drives the price of Bitcoin. Great, but what drives the price of an enterprise? Cash flow, volume, expenses, capex. And these enterprises have no capex. So I find that just compelling, that if the volume through the market, for whatever reason, either speculative or maybe cross-border settlement or maybe some sort of FX market takes root and the volume goes up 10x, that'll draw in capital like a vacuum. And then you'll see, stablecoin liquidity has stabilized of late. You could see that easy on the llama. And that's comforting from an altcoin price. Bitcoin has quite a different narrative, and Ethereum as well, because of how they're acquired and traded on centralized exchanges. But the altcoins are predominantly on chain because it's a relatively sophisticated investment thesis that probably isn't the go-to for centralized exchange actors. Centralized exchange actors are there for price speculation. But on chain, because if you're interacting with like a curve on a centralized exchange, you're not taking part in any of the revenue, any of the cash flow at all. But if you're taking part with curve in the DeFi space, you know very well about the volume, about the weekly cash flow that they distribute to us, as well as the vote rental incentives and that part of the cash flow regime. So it's quite different, centralized exchange versus actually what is the protocol and what is it doing. So one of the interesting things I think about so often is time. 2020, before 2020 there was nothing. Late 2019 people saw Uniswap V1. So everything we're discussing is post 2020, and you can't define it as like one cycle. A cycle, that's a word that's trying to talk about a time period. My sentiment that I'm trying to express is it's a very, very small group of people that understand what these systems are, how sophisticated they are, and their characteristics, their attributes, their usefulness as a product and a service. And obviously, I talk about it. I talk about these systems as enterprise, as business. So this is very early, early in the enterprise phase, stage of crypto markets, where you actually have a capacity to evaluate these protocols in terms of a business with a balance sheet as a value assessment versus a relatively trivial and arbitrary at times growth narrative. Dan's in the house, a pleasure. Killis, my fave thumbnail yet. I like the AI stuff. Juan, hi all, crazy market. Good morning, Cap. Sir Joe, a pleasure. One curious, crazy market. It's not that crazy. It's not that volatile. It's kind of like we had a leg up, which means in a relatively constrained liquidity environment, a leg up means a chunk of capital migrated into the space, a flow of capital. So it's a start. If another flow happens, now, it's like every cycle, it's a reset. So right now, we've had a bear market for almost 2 years, significant price depreciation, significant volatility. So we had a bottoming, and then we had our first flow in. What happens? Another flow. One. Now anyone that's looking at the market after the next flow, like a burst of capital coming in, they see, oh, we just went from 27 to 35, and now it's 32 to 38, and that is the start of the momentum process, and that takes time, a long time potentially. It could take months. Check back in a quarter, 2 quarters, 3, 6 months. But it's a start. And I hope that brings people comfort. It brings me comfort. I think these markets are protected in a lot of ways for systemic liquidity disruption. Why do I say that? There's so much more shit to sell in the equities markets as compared to the crypto markets. We already had our forced selling in crypto markets in 2022 and most of 2023. The vast majority of folks in crypto markets that have remained, they're likely not the forced sellers, or at least not the forced seller to the degree that occurred in 22 and 23. So at worst case, there has to be significantly less forced selling potential available now as compared to 22 and 23. And that unto itself screams higher lows, right? So at worst case, it doesn't make sense that you could even achieve lower lows considering where we are and that it ticked up. When does Ethereum outperform Bitcoin? I think it's going to be quite some time. And this happens, they would say, every cycle. But the narrative for Ethereum isn't the same as Bitcoin. Bitcoin being counterparty risk and, expatriation of money, offshoring of money and getting money out of a sovereign fiat regime. So that's the whole Bitcoin narrative, and that's meaningful, and we all subscribe to that. I tell everyone it's Ethereum, Bitcoin, stablecoins for the cash position, and you adjust your levels accordingly. And right about now, I'm skewed towards Ethereum, and then second is Bitcoin, and then the smallest is the cash position. And that has served well over the last couple of weeks. Ethereum was a big bump in price, and so was Bitcoin. So that worked out very nicely. Look at the S&P just hovering. It's kind of like what's a good way to describe it? Doldrums. Like, oh, look at the market. It's okay. It's not bad. It's gonna the malaise, indifference. People are getting not disillusioned, but they're disappointed with the volatility. So maybe that leads up to some sort of volatility event. Um, I would love to see the long end rally. I would love to see the whole U.S. debt market yield curve structure uninvert. I would love to see the return of healthy short end versus long end, where banks are able to actually execute their business as they historically have done. That'll cause the collateral appreciation. That is the forward-looking indicator on liquidity conditions. So even if you have like a lower high on global systemic liquidity, you're still going to have your impulse from the trough to the peak. You know, cycles will cycle. Yeah, they're draining liquidity. There'll be a bottom, and you'll have your pop in liquidity. So maybe that's really the next cycle is a lower high in systemic liquidity. They're trying to constrain the system, and they want to have control. They want the control. And that pop in liquidity combined with the emergence of significant narrative, enterprise narrative in crypto markets accounts for significant flows. So a reduced pop in liquidity, which probably is best described as like a disparity, because without the significant pop in liquidity, where GenPop has access to a lot of excess capital, which they did in 2020, it's not there's not participation from just the same number of people that occurred in 2020. Maybe we'll see a smaller subset, a smaller population of persons engaging in crypto markets in the next cycle whenever it occurs. And I don't think it's like just hedge funds and you know the Wall Street narrative. The Wall Street is coming. They're going to buy our bags. I don't think it's just them, albeit the Bitcoin and Ethereum ETFs are quite consistent with that kind of statement. And there's just such a small supply of spot Bitcoin. What are these damn ETFs going to do? They have to have inventory to be able to sell. It is very much a reasonable statement to make that these ETFs could send Bitcoin very parabolic because there just isn't the inventory. And then there's a scramble and a frenzy just for the banks to get their hands on a quantity of Bitcoin because they want to sell it to their customers that are buying the ETF. And that may be part of what's playing out. And I think that's actually the case. So what does that mean for me? If I think that it's the case that Bitcoin has a capacity to go parabolic in response to 3, 4, 5, 10 ETFs coming online and their scramble to acquire inventory of a relatively limited supply asset, spot-wise, and the fact that I compose my portfolio weighted towards Ethereum at this point. Bitcoin is cash. And these investors in the ETF, they'll respond to the price point, treating it as an investment, but I don't use it as an investment. So I'm being rigorous with my definition of how I've described these different parts of the portfolio and what I want them to be and what I want to use them as. So Bitcoin Cash, not Bitcoin Cash, Bitcoin as cash. And Ethereum clearly is a form of cash because you have to spend it on gas. I mean, everyone here is spending, $10, $15, $20, $30, $40, $50, $100 a week just claiming stuff. So you need it, and that's a big narrative for why you need it. And then the ETF as well, it's not as scarce as Bitcoin, so you also have those banks they need to acquire inventory to sell products to their customers. So the narrative of the ETF is there for Ethereum as well. But then, unlike with Bitcoin, you have the active economics of the system that draw in interest and thus draw in capital. And to interact in crypto DeFi space, you need Ethereum. So there's, I would say, a bit more of a narrative to be woven for Ethereum price appreciation as compared to Bitcoin. Bitcoin first, because probably Bitcoin gets its ETFs, its spot ETFs approved first, but there's multiple reasons to think that Ethereum could outperform. I don't know why we would think Ethereum could outperform. I mean, it's not like the chart says historically Ethereum outperforms. And what's so fascinating here, let's zoom in a little bit. We're obviously very zoomed out. What's so fascinating is the way I simplify looking at these markets. This was maybe I should use rectangles. This is a completely different world. What happened here on the left is nothing like what's going to happen the next cycle, because this was literally just centralized exchanges, centralized liquidity, a wire transfer or an ACH from a bank account to an exchange and trading on price. When everyone sold, when the market came down and the cash went back to the exchange, what the hell are you going to do with it? You get it off the exchange and you do it, and you pursue other investments, capital flows from underperformance to outperformance. So this world here is nothing like post-2020. Post-2020 and everything we experienced in 2020 and 2021, everyone has to agree it's a completely different conversation what is going on Ethereum mainnet and all the L2s and all the roll-ups and everything that has been built. And they're still building, and Rax's narrative. Oh my goodness. Oh my goodness. Can you explain about correlation of S&P and BTC lately? Seems like correlation is going down. So correlation implies literally just the chart. And correlation is often transitory, meaning at times things are correlated, at times things are inversely correlated. So folks used to say, rather than the word correlation, they used to say the word coupled, as in, all right, stock market goes up, crypto goes up. Stock market goes down, crypto goes down. That was a misinterpretation of the pressures on the respective markets. And that was very much a liquidity-driven phenomena. This market back here in the left circle, that was just pure liquidity. And you had great correlation with equity markets, because what do you have in equity markets? You have dog shit. You have paper that's based on price speculation. And you have dividend investors that are deluded to think that 2, 3, 4, 5, 6% and the associated volatility of the equity instrument is even acceptable. So basically, the vast majority that is offered by equity markets is literally just bullshit liquidity driven. And you see that very nicely. Where did you see that? Here, this is what I have this up. Look at the S&P. And then look at Bitcoin, denominated in the S&P. I wish I could overlay these. Let's see if I could fix this. Regular. Move to left. Yeah, I'm messing this up already. Oh, no, I want to... it's really big. No, that's not the chart I wanted to get. But if you look at Bitcoin denominated in the S&P versus the S&P, it looks very similar, which implies the correlation, the coupling rather, was always a liquidity coupling, except now It's not the same narrative with regard to stuff other than Bitcoin. And hopefully Bitcoin does what it does with its roll-ups and its VM and things like that, because where do you think the protocols are going to deploy to? If there was ever an EVM solution or some sort of smart contract solution or some sort of programming implementation that's supported by Bitcoin without like literally on chain, that'd be quite appealing. Albeit you still have things like Syscoin and Rootstock, which are significantly more robust than anything they could build, roll-up wise, or the BitVM concept. I mean, literally, it's a full EVM. Syscoin is very far ahead. It's a full EVM on Bitcoin. It's secured by Bitcoin. It just doesn't have the traction that many hope it would have. Anywho, that's not a bad chart. I need to get this logarithmic, though. Logarithmic. All right. It's not coming out the way I would like it to. Gal's in the house. Good morning. That's it. It's a boring Friday. Equity markets are marginally green. Look at the equal weight S&P, and that looks like shit. I mean, that's literally the definition of a rolling top. Lower low, lower high, but just bare. It's just literally a ceiling, and it just rolled over like I'm done. I got nothing left. So the S&P is obviously much more concentrated with the Magnificent Seven, and clearly it's running right into the monthly TWAP. So structurally, technically, this looks much healthier, but then the equal weighted. It's down here. I have to get rid of this. Equal weighted S&P just has this ugly rolling top as compared to the S&P, the RSP. Russell 2000, same thing. It looks just as bad as the equal weighted S&P, which tells the story of where we are financially. The vast majority of the stock market is crashing. It's horrible structure. Nothing. I mean, this is about the push for a lower low. This is actually quite stark. I'm surprised I haven't noticed that. We're talking about October earlier, June 20 of 22, June of 22. If this pushes below here, that could be quite significant because obviously software inspects these charts, and a year and a half later, you push for a lower low. And this is the Russell 2000, so this is your expression of equity markets. Probably one of the broadest expressions of equity markets, even more so than the RSP. So this is quite meaningful for us to understand that as much as we're seeing flows in the crypto markets, there's a whole lot of shit going on, aside from the geopolitical complexities, which are unfortunate in all regards. Anything else? DXY. It's been moved by the yen. Euro's basically off the table, pushing it around, but it's the yen that's been pushing it around. And the yen going from 150.4 to 149.6 in the amount of time that it has is quite extraordinary. Reverse repo keeps draining down to 109, goes right into the short end. Treasury doesn't mean much right about now. Let's look at, where's the liquidity? I have my here. Liquidity. You see, this is my liquidity indicator that I use. It's generic. It's an Arthur Hayes thing. It's not like Mike Howell and his incredible, remarkable inspection of the global liquidity composition. But unto itself, it's horizontal. In fact, it's a higher low as compared to December of 2022, which is going on almost a year ago. And that's why markets are relatively muted in volatility, because the systemic liquidity has been supported. And this is bolstered predominantly by the draining of the reverse repo, which is the excess currency supply that the Fed financed and paid for. And now Treasury is sucking up that and putting it in their Treasury general account. And they're running just the world's largest deficit. Quite remarkable. Gold hovering below 2,000. That's quite fascinating. I like this. This is gasoline futures. So you see a bit of a correlation between it and oil, but I would say that gasoline futures leads oil. So gasoline futures, bam, on the 3-month. So there's two things to keep an eye on. RB1, bang, gasoline futures. See if it pushes below this time weighted average price on the 3-month. Would indicate oil is likely to roll over a bit. Oil rolls over, dollar might roll over. Dollar rolling over means, what does it mean considering what the hell is going on in Japan? It's a mess, currency-wise. But you know the drill. Oil rolls over, dollar rolls over, systemic liquidity increases, and if you combine that with like the move indicator rolling over, at some point this thing's gotta roll over. And it's just such an elevated volatility for U.S. government debt. Move rolls over, and then we get our liquidity cycle, and the liquidity will probably be less than the 2020 liquidity cycle. Let's wrap it up for today. I appreciate all of you hanging with me to the end of the stream. 16 people made it to the end, 9 likes. Smack that thumbs up button. I appreciate all of you. In the description, link to the most rational community in the crypto space. One curious view, yeah, it's looking rough on all global markets. Crypto is the exception. Well, I'll be here. We'll be looking at the data. And heck, with locked positions, you are guaranteed to be there when the market bottoms. And that's like me saying, I will pay for front row seats when the liquidity cycle finally flips. Have a good weekend. Catch you next time. Peace.